All right, let's get to today's topic. Mortgage rates have tumbled in the last 48 hours due to the 10-year Treasury going down, which also was caused by some of these bank collapse. So let's bring up some articles for you guys, and maybe we'll put these articles in the chat as well. All right. Let's bring up the first article. For those of you who don't know about the bank collapse, you put it up already? Okay, there we go. There we go. So I'm not going to read this whole entire article. I just want to get to the point of why the banks failed. So I want to scroll to that on my end. So it says Silicon Valley Bank, SVB, failure explained. This was put out a little while ago by USA Today. So Silicon Valley's customers, who were largely startups and other tech-centric companies, started becoming needier for cash over the past year. That led to them withdrawing money from their accounts. SVB, meanwhile, needed to keep selling its assets, mainly bonds, at a loss to free up capital so that customers could withdraw funds. Let me repeat that. SVB had to keep selling their assets, mainly their bonds, at a loss to free up capital so that customers could withdraw their funds. But the bank got to a point where those losses were so high, consumers began to fear that SVB couldn't guarantee access to every customer's funds. That fueled a massive bank run, which caused the FDIC to step in. Wow. Yo, that's crazy. So you trying to tell me a bank didn't have no money? Yo, you can't make this up, y'all. Now, look, we only reading what the news is telling us. I'm pretty sure there was a lot more underlying factors than this, right? I'm not going to sit here and pretend like I got the inside scoop on SVB and the workings, but I guarantee you guys there was a lot more to this. I'm just telling you what I read in the USA Today about 30 minutes ago explaining this, and I just wanted to explain this for you guys, for those of you who didn't know. I'm not going to go into deep details about this bank failures and make my own speculations. I really want to talk about mortgage rates in today's episodes and why you need to buy real estate. But let's go to now Signature Bank. Signature Bank, let's scroll down. And I'm not going to talk about the deposits they had and everything like that. Y'all can read the article yourself because I'm on a time crunch today. We got a hard stop today. So where is this one? Signature. This is a long-ass article, too. All right. Why did Signature Bank fail? Signature Bank, and you know what's so crazy about Signature Bank? They opened up in 2001, from what I was reading. I started banking with them in 2004 when I first really started in the mortgage business. Signature Bank is the first bank I opened up a business account at. That's crazy because they're headquartered here in New York. So my broker at the time, he was banking there, and he recommended me to go bank there, and that was the very first business bank account that I had at Signature Bank. They had great service, everything was top notch there. So I'm kind of a little sad to see this because it has a little sentimental value for me in my own personal life because I actually banked at Signature at one time. But Signature Bank is a New York-based financial institution that became a big lender in the crypto industry. Was ordered to close over the weekend. That bank was part of only a handful of financial institutions allowing customers to deposit crypto assets. That didn't bode well for the bank when crypto plunged as a result of the FTX collapse last year. Signature board member Barney Frank, a former congressman who helped design new financial regulations after the 2008 financial crisis, ultimately blamed SVB for its collapse. It was a SVB-generated panic, he told the Wall Street Journal. We were fine until last couple of hours Friday. That sounds like cap. I'm sorry. Hold on. My man Barney Frank said, we were fine until Friday afternoon, and you closed on Sunday? And you got shut down on Sunday? Come on, bro. Yeah. Barney Frank, you sound like you're talking a whole lot of cap right here. I'm sorry that I'm just calling it how I read it, ladies and gentlemen. This don't sound right. You wasn't fine. There was some underlying factors of things going on here at Signature Bank. Allegedly, I don't want to get sued, so I'm going to say allegedly, right? But this sounds crazy to me that you blaming SVB collapse. What happened to all other banks? No one else collapsed? No, I think it had to do with the crypto plays. Me personally. But I know Signature was a heavy hitter in commercial real estate and funding commercial deals too. So it's interesting to see how that's going to shake out in the next couple months now that a big major commercial real estate funding source is gone. So that's going to be interesting to see, right? So look, this is what I'm going to do, because I'm not going to sit here and read this whole article. You guys can read this on your own. I just wanted to explain, and look, let's get some more likes in this video, please. It's about 500 of y'all. I just put the link to the USA Today article. You guys can go read that, right? Now let's go to the mortgage rate conversation real quick. Before we go to the mortgage rate conversation, go to the bank failures slide, right? So now, this is, and I'm going to send this one in the link too, right? This is from bankrate.com. Bankrate.com. They put out a list of, and I'm going to put this in the chat, in the live chat for y'all as well. So y'all can read all about the bank failures. But I wanted to, because for the past couple days, I've been seeing a lot of content going out there about bank failures. There's more bank failures that happen. 2008 and 9 is going to repeat itself. More banks are going to go out of business. I've been seeing all this type of content. We've been kind of quiet on this subject because I was like, yo, let's just let this play out. We got other things we're doing right now. We had the webinar this weekend. So I wanted to kind of focus on that. I want to show you guys this, right? And this is why you got to take everything with a grain of salt. Can you make it bigger? Pause. Because I'm looking at it here on my screen right now. It's kind of small. Yeah, make it a little larger. A little bit larger if you can. Because you can't really see the numbers. All right. Now this is better. Right? Now, stay right there, Tukes. This is showing you that since 2009, y'all, 2009, there has been a total of 513 bank failures. But I want you to scroll to the bottom of this so we can get to 2009 right there. So let's look at, scroll up some. Scroll up. Up, Tukes. Yeah. To 2009. So that way 2009 is at the bottom, not nothing else. Yeah. So at 2009, there was 140 bank failures. 2010, there was 157 bank failures. And 2011, there were 92 bank failures. Somebody add that up. How many bank failures is that in 3 years time frame? Add that up. 140, 157, 92. 140, 57, 92. Put it in the chat real quick. How many bank failures was that during the Great Recession of the subprime crisis? 389? Because I'm not pulling out my calculator. So if you want to look at this, right? When you see videos of people that are out here making videos right now, and if you see anybody trying to compare this to 08, 09, 2010, I want you guys to be very, I don't care who the person is to. I want you to take their content with a grain of salt from this point moving forward. Because when you look at how can you compare, some of y'all said 382, some of y'all said 389. I don't know who's right because I'm not adding this up. But either which way, I don't think we'll ever see something like this ever in history again of that many banks failing in a short period of time. And if you look at the years prior to, you still have some trickle effect, but you can see from 2012, 13, that number is decreasing every single year. Even scroll up now, scroll up, Tukes. Now, in 2018, there were no bank failures at all. 2019 and 20, there were 4. And those 4 failures happened after America shut down, right? And they even break this down in this bank rate article, which I'm going to put again. You guys can read this article yourself, right? And I'm giving you this, and I put both of these articles in here just so you guys can now start doing your own due diligence and own research, so you don't really depend on people who are making content, because everybody has an agenda, right? Look at these numbers. You can't compare the past to what's happening right now. The underlying conditions are different. This is unfortunate. This is unfortunate that these two banks failed. And these were big banks. These were not small banks. But they took a lot of risk, right? They took a lot of risk in the type of companies and things that they were funding and doing business with. Tech is risky right now because of what's happening in the marketplace. Crypto, risky, right? Crypto damn near crash.
Yeah.
You know what I'm saying? So there's a lot of different things. And again, guys, there's always underlying factors to all these different types of things. So I'm pretty sure it's a lot more than what we know right now that really ultimately caused the demise of these two banks. But I just wanted to show you guys this list so that way you can really understand. In the past 2 years, there's been no bank failures. And in 2020 and 2019, there was 8 total. Banks fail all the time, apparently, right? According to this. But it's not something that happens often. Obviously, this is going to be big news today because it hasn't happened in 2 years.
Yeah.
And these were two, I think SVB was like, according to assets, they were like the 16th largest bank in America. Many of us probably never even heard of SVB until this week of when they failed. So I'm going to tell you this. Don't panic. Don't panic. The FDIC is, according to reports, is insuring everybody's money. So you'll be able to pull out your money out of these banks. But don't just start pulling out your money because you don't trust the banking system. The banking system clearly has shown that it made its mistakes in the past, and regulation has kept banks open and kept banks afloat. Now, will there be more bank failures at some point? Absolutely. This is stuff. People go out of business every day for making bad business decisions. It happens all the time. And we will continue to see that. But I don't want you guys to be alarmed and kind of going crazy thinking if your money's protected or anything like that, right? Your money's going to be protected if these banks fail, but diversify your money because, you know, the FDIC only protects, they're supposed to only protect up to $250,000. If you got more than $250,000 in your checking or savings account too, I think you should reevaluate your situation anyway. I think you should start learning how to trade your money in the stock market and stuff like that to make it earn money because inflation is eating out your cash anyway. But that's another story for a different day. Well, but no, we're going to talk about that today. Now, let's go. So does mortgage rates go up or down depending on bank failure? Has nothing to do with that. Sydney, I'm glad you asked that. But in this case, it did. Let's go to the mortgage rate conversation, right? And I'm going to put this CNBC article that came out today in the chat for you guys to read on your own. And let's go to mortgage rates tumble in the wake of bank failures. Now, the average 30 rate on the popular mortgage, make it a little bit bigger. It's kind of small. Pause. Yeah, that's good. Yeah. So the average 30, and I'm just going to read the key points, and then I'm going to go on my own rant. The average 30-year rate on a 30-year mortgage dropped to 6.57% on Monday. If rates continue to drop now, buyers could return to the housing market once again. Another bullet point says this mini banking crisis has to drive a change in consumer behavior in order to have a lasting positive impact on rates. It's still all about inflation, says the chief operating officer of one of my favorite sites, Mortgage News Dailies. Now, type in mortgagenewsdaily.com because I know it's already up there. Let's go there.
Okay.
Right? So now, scroll down. So now, Mortgage News Daily, guys, I tell you guys all the time, this is the website that I use. Make it bigger. Pause. So that way the chart is bigger. Yeah, there we go. So this is something that I tell you guys all the time. I use this website. Use it yourself to track mortgage rates, to see what's happening in the market. You see CNBC is quoting everything from here, right? It's a super credible source that most of these news outlets are using. The mortgage rates right now on a 30-year fix with A1 credit, 20% down, primary residence around 6.5%, right? Last week it was just a little bit over 7%. Mm-hmm. So the bank failures did in fact help mortgage rates, but it helped the 10-year treasury. See, the mortgage rates loosely follow the 10-year treasury. And the 10-year treasury, as that falls, mortgage rates fall as well. In most cases, right? There's some cases it doesn't, but in most cases it does. So the 10-year dropped, and I think if you scroll down, they might have the 10-year chart up here, right? Yeah. Stop. Wait, hold on, go up. Yeah, so the 10-year chart, so you see it's down to 3.5. No, the 10-year, right there, just stay right there. The 10-year is at 3.5%. I think last week that joint was like 4.5, 4.6, somewhere right there. So that significant drop is why you see mortgage rates drop. But we have, and you can kind of see like the little chart on the bottom right there too. Maybe I need to have, because I think you told me this before, to have a class kind of breaking down, like how MBSs work and a 10-year treasury. Maybe I'll do a class like that, because this is what really controls mortgage rates and really how you can kind of time if it's a good time to lock in or not, or if rates are going to go up. Maybe I'll have to do that. But I'm saying all this to say, this website is Mortgage News Daily. Mortgage News Daily. Type it in chat. MortgageNewsDaily.com. All right. I'm saying all this to say, mortgage rates is all about timing. You can take this off the screen. Mortgage rates is all about timing. Things happen all the time in the market that fluctuates the market. It's just like the stock market, y'all. When you see the stock market going up, down, left, and right, same thing happens with mortgage rates. Just on Friday, we were quoting people almost 7% because it started to dip a little bit once that news came out, because the 10-year treasury started to dip after, I think last Wednesday is when they announced this first SVB failing. Mm-hmm. And then now, this rate is going down, but it fluctuates all the time. So it's all about the timing. If you're not in contract, you can't take advantage of these rates. And this is why I always tell you guys, stop waiting, right? Go out here and execute at the highest level when you're talking about buying real estate, because if the rates do drop like they did, 50 basis points, you ain't in contract. You can't take advantage of this low rate right now. If you're just going to say, oh, rates drop, let me go start house hunting again, you're behind the 8-ball. It's nothing that you can do to take advantage of this. If this thing drops another 50 basis points to 6%, doesn't mean it's going to stay there. These things move up and down, left and right. And we have so much news coming out this week now. We got the inflation report that comes out tomorrow. That's a big report that's coming out tomorrow. And if inflation is not, that number is not decreasing at a level that the feds are happy with, they're going to probably do what? Raise the federal funds rates. And that could offset and trigger so many different things, right? So, yes, mortgage rates did tumble. Bank failures, generally speaking, have nothing to do with mortgage rates dropping or going higher. It's all types of different factors, but the most important factor with the rates dropping is the 10-year treasury. If that 10-year treasury continues to go down, and if inflation now goes down and beats the estimates of the experts, then it can go even further down. So the moral of the story is, lock in your damn interest rates when you have the opportunity to. Lock in your contracts. Don't be out here. And I don't care what Robert Kiyosaki just said, don't buy real estate. We're not listening to him or anybody else. Listen to your damn self. Right? Don't even listen to me. Don't even listen to me. Listen to yourself. Listen to the numbers. Do the numbers make sense? I don't care what none of these experts say. if I see a deal that makes sense and is making cash flow, I'm gonna buy it. If I want to buy a new house and these rates got a little bit cheaper for me and I was already house hunting, I'm gonna be more aggressive to go find me a house. Because what I wanna do is take advantage of the drop before that thing go back up.
So my question is, how did so these two bank closures, did they did not affect the interest rates? You're saying? Because normally they don't.
Directly, no, but indirectly, yeah, because people are panicking and worrying, right? People are in panic mode. The 10-year treasury wound up going lower. That's what directly impacted the mortgage rates, was the
Right.
10-year treasury going down.
Now these bank closures didn't affect the 10-year treasury, or they did?
Directly and indirectly,
Okay.
right? It's news. And
Right.
these things are traded on the markets. So when you're dealing with the volatile market, bond markets, stock markets, everything like that, it's volatility. Any news that comes out can send certain, yields going up or going down.
Yeah.
It just depends on what news is coming out and what's happening. So all news generally impacts rates, Federal Reserve decision making,
Yeah.
et cetera, et cetera. So indirectly, yes, it has something to do with it. But when I see people saying, because if more banks fail, will rates continue to drop lower? No. Realistically, it shouldn't. But who knows how the markets overall are going to react to everything. My whole thing is, what I'm trying to tell you is, go out here and make wise real estate decisions. Period.